So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we are going to be talking about some vertical spread examples and also going through the advantages and disadvantages of trading spreads. So first of all, what is a vertical spread? Well, there's two types of vertical spreads generally. There are debit spreads and credit spreads. Debit spreads are when you are trading two different option contracts, and the net result is that you end up paying a debit. So you're paying to get into the position, which means that you're an option buyer. If you do a credit spread, that means you're trading two different option contracts, but the net result is that you get paid a net premium or a net credit, which means that you're an option seller. So in either case, though, they are still classified as vertical spreads because you're trading two different contracts. Where you can differ on, or where you can adjust your spreads, is mostly on spread width. So how far out you end up selling the contracts or buying the contracts from one another. So an example of a tight vertical spread might be if a stock is trading at $100, we might sell the 98 put options and buy the 97 put options. So we would be a net credit seller in that case, and we'd be doing a $1 wide spread. Now, if we wanted to do a wider spread, then what we would do is sell the 98 put options again, but then buy, say, the 95 put options as a $3 wide spread. So now we're doing the spread a little bit wider. So there's a lot of wiggle room, obviously, and you can do wider spreads or more narrow spreads as you keep going forward. The main advantage to doing spreads is that you control your risk in those positions. So that's why I suggest it's actually good for new traders. Even if you're a little bit advanced, still using spreads is not a bad idea. We use spreads all the time because we can control the risk. It has built-in risk management. And so when you do a spread, you can never lose more than that spread differential in the contracts. So you know exactly how much you can lose on a contract, which means that you can control your position sizing really, really well and not get carried away with any margin calls or margin requirements. The downside to then trading spreads as a generality is that because of this risk control, you do give up some of your premium. So as we said earlier, if you're selling one option and buying another, that cost of buying the other option contract means that you're going to make generally less money or have a little bit lower probability of success. Now, it's not a huge difference, and it depends on how wide you sell these contracts and still how far out of the money you buy or sell contracts. But that is the main thing that you give up, is you give up a little bit of, upside potential on that spread because you have to buy that insurance, basically protection, that defined risk protection. Ultimately, though, you can do them really, really wide. That's what we do a lot if we do an iron butterfly trade. So we'll do a wide iron butterfly where we'll sell at the money contracts, but then buy our further out wings, say, $10 or even $12 out in some cases, and they're really, really cheap. So effectively, we're buying very cheap insurance or protection in case the market continues to be volatile as it's been over the last couple weeks. So hopefully that helps out. As always, if you guys have any questions or comments, please let me know. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.